David, you chaired the AP conference in Adelaide this week, and the central theme was that cost blowouts and capacity constraints could threaten this kind of massive pipeline of LNG projects we've got underway. You've got a $16 billion coal seam gas to LNG project in Queensland, right next door to a BG project, which recently announced its cost of blown out by $5 billion. Are you experiencing those same sort of pressures?
Yeah, I think the key thing, the really big message at this conference is, yes, we've got $180 billion of projects in the pipeline. They're actually sanctioned, approved projects. The real question is, will we be able to prove the next phase of projects that go beyond that $180 billion? That's really where the core focus of the conference has been. And it's really been around our ability to operate safely, our ability to gain the trust of all the communities, and also a request of government, a very clear request of government. In order to invest the future wave, we need stable fiscal and regulatory environments in which to operate. So those are the key three fundamental themes that are associated with this conference.
But if one of those existing projects in the existing $180 billion pipeline has already had a 33% cost blowout, what hope have we got of that next generation of projects?
I think the key thing is everyone knows that Australia is an expensive place to do business, but equally everyone also knows that the extraordinary investments which have happened in this industry have come about because of the rise in Asian prices. The key thing for us to manage is obviously our cost base in Australia, while also staying competitive so that we continue to sell, in our case, gas, but there are other commodities, but in our case, gas, into the Asian market. So yes, a number of parties in Australia are under cost pressure, and the key thing for us is to manage that cost pressures in such a way that we actually deliver our projects, that they actually work, and they're actually ultimately will create enormous wealth for Australia. So what we as an industry are focused on is delivering that $180 billion of projects, selling the gas into the Asian market, and creating vast amounts of wealth for the whole of Australia.
David, is your project blown out by 30% in terms of capital cost?
The issue on capital cost is clearly projects are under pressure as they go forward. In the case of my project, which is the easiest for me to talk about, then we have worked with three very big contractors. Bechtel, Saipem are building the pipeline, and Fluor are doing the upstream. So we've chosen a contracting philosophy whereby we have lump sum with Bechtel, lump sum with Saipem, and a target price with Fluor. So we've sought to manage the costs in that manner. Obviously, we've quoted the projects in US dollars. So some of the increase you see, some of the headline increase you see, is because clearly the Australian dollar relative to the US dollar has been very strong. But for a company such as us, which is an Australian company earning money in US and Australian dollars, then in fact that doesn't actually make any difference to our bottom line, though it does increase the headline prices. And I think you referred to earlier in an earlier question about the BG project, half of their increase came from the fact that the US dollar has been so strong, the Australian dollar has been so strong relative to the US.
David, in terms of those Queensland, the three Queensland LNG projects, you know, in rough terms, how far advanced is the physical construction? Are they 10% completed, 25, 50? What roughly, how much of those projects have been, those LNG projects have been completed building-wise?
Yeah, BG is probably slightly in front of ourselves, and we're probably slightly in front of APLNG. For our project, we're approximately 25% complete. So what I always say is we've done one lap of the track. That's gone well. We've got 3 more laps to go. So executing those 3 more laps is going to be crucially important for us. But right now, we're about 25% complete today, which effectively means...
What about the WA projects? How many of those are still in I'm talking about those in the 180 billion. How many of those are at their very early stages?
Well, Gorgon clearly had made very good progress. So it's been, I think it was proved a couple of years ago. And if you look at Barrow Island, it's made clearly very good progress. Ichthys is much more in its infancy. It's just recently been supported, so it's much earlier in the cycle. And Prelude also, which is the Shell project, also is much earlier in its cycle. But right the way throughout, these projects are making progress, and they are doing it in obviously in an environment where managing costs and managing schedule is critically important. But what's really important for the whole industry is that these projects are successful. Because ultimately it's about brand Australia. It's about selling Australia into the Asian market. And the Asian market needs to have confidence that we can all deliver projects well, we can deliver them safely, and we can operate them efficiently once they come online, and thereby deliver the cargoes into Tokyo, into Seoul, into Malaysia and China, as we've all committed to.
David, when you talk to Australian bank CEOs, you discover that they are not forecasting another global financial crisis where the banking system is frozen, but they realise the clear danger and are preparing for it. And the recent moves in the stock market are part of that nervousness. What will happen to these big projects if the banking system is frozen? And many of the banks who have agreed to fund these projects simply can't find the money.
Yeah, so probably two answers to that. It depends, obviously, who you are and what partner you are. A number of the partners, such as Petronas in our case, Total in our case, with other big firms such as Shell, they basically can fund these projects straight off their cash flow from their global businesses. So they don't need to borrow large sums of money against a particular project. So that's one group of companies. A project such as ours, we've taken great precautions and we've been very prudent to make sure that right up front, we've basically got sufficient funds to fund the whole project right to the end in 2015. Now, that is obviously a combination of equity, shareholders' money, and also debt. But the debt is all agreed. It's with, in our case, with very strong institutions. A lot of them are Australian institutions. So, the debt is very strongly underpinned by really strong lenders. And in our case, I think the probability of the whole global banking system collapsing is one I don't think we're contemplating at this stage. But as I say, from our perspective, we're well funded. My company itself today, we've got $3.5 billion of cash plus the funding from the banks. So that is sufficient to get us right the way through to the end of 2015 when we start to see the revenue really coming through.
But there's no suggestion the global financial system collapses. It's just that, as happened last time, it freezes for 6 months, and people go on doing their business, but you can't get money offshore easily.
In that situation, we're perfectly all right.
However, there could be some projects amongst the lot that perhaps are not as cash flow based and don't have their money organised with people who can get through this, and they may be delayed.
No, as an industry, once you go to FID, which is the financial investment decision, you don't make that decision until you've got the funding that fully supports that decision. And all partners obviously insist that other partners have got the wherewithal, the funds, in order to take you right the way through the project. So basically, the projects that are already approved are fully funded. So if there's any influence, it would be on the subsequent pipeline. But again, most of the oil and gas companies involved globally are very strong players. They've got very good balance sheets and they've got access to capital.
David, that second wave of projects that you talk about as a subsequent pipeline would roughly more than quadruple the existing capacity of the system. There's a view expressed at the conference that you presided over that we're looking at something that's way too ambitious for an economy our size. Do you have a view on that?
I think it is ambitious, absolutely. If we deliver on this phase of projects, or I should say when we deliver on this phase of projects, we're going to be matching Qatar in terms of LNG exports. That is an extraordinary outcome. As I say, it's come about because of strong Asian prices. But we know that there's, let's say, another 20, 30, 40 million tons of LNG in the pipeline that is being considered for sanction. That really will mean that Australia becomes a really serious player in the gas world in Asia. Now, the advantage of that, obviously, it creates enormous wealth for Australians, it creates enormous tax revenues. It also, in fact, makes a contribution to reducing the carbon footprints, both here in Australia, but also in these Asian countries, which typically either burn coal or oil. So it also makes a good contribution in that area.
But traditionally, our LNG has been sold at prices that are linked to oil prices. You would have seen that recently the approval was given in the States for their first export LNG terminal, I think in Louisiana, Cheniere. which is going to sell on Henry Hub-based pricing. Does that represent some kind of threat to the pricing model that we've developed these projects on?
Yeah, that's correct. We believe that Cheniere Sabine Pass is going to go forward. It'll be a 16 million tonne when it's at full capacity. Our understanding, generally understanding in the industry, is it costs about $8 to take a molecule of gas from Henry Hub and deliver it to Tokyo Bay. So on today, that means you could deliver into Tokyo Bay for about $10.50. The price of LNG, liquid natural gas, same molecules into Tokyo Bay, delivered perhaps from an Australian project, is about $14.50. So clearly there is an opportunity for US exports into Tokyo Bay right now. But of course that makes the assumption, a couple of important assumptions, but the main one is that Henry Hub prices stay as low as $2.50. The other issue here is I don't believe that US exports are going to be a huge contribution of global LNG. There's a clear indication that the US government would step in the event that those exports get too large. And at the end of the day, I think it's commonly believed that probably US exports are unlikely to be more than 10% of global LNG demand, which in 2025 will be about 350 million tonnes. So yes, it's a factor, but probably at the end of the day, not an important factor.
My understanding is that the US is not going to be a major LNG exporter, as you say. However, what they're doing is to use gas to completely transform their economy. They're going to introduce manufacturing businesses. They're going to reduce their taxes to bring money back to develop this. They'll propel their cars. They're going to become independent of the Middle East. Now, why wouldn't we do the same thing?
Exactly. I very much hope we will.
We had the guy from Incitec saying the other day that they'll be putting their next ammonia plant in America, and we'll export the product back to Australia. Why wouldn't we do that too?
You're exactly right. I see no reason why we won't do it. So let's just look at why it occurred in America. What occurred in America was that gas prices started to rise. Then the operators in America started to get the drill bit out. As the gas prices rise, the number of rigs in America went up to 1,600 rigs. They started drilling masses of holes. They unlocked the shale gale, as it's called, but it unlocked shale gas. What happened then was the prices started to fall. And if you look at the numbers of rigs operating, they started to drop and prices have come all the way down as they use technology to completely unlock a new source of gas which none of us really anticipated. And we never anticipated getting to these levels of prices. Now, on Monday, Minister Ferguson said that Australia has 400 TCF effectively of conventional and gas that's in sandstones, and he said we have another 400 TCF of gas which is in shales. So what we need to do in Australia is follow the American model. We need to unlock those resources. We need to get the drill bit out. And what will happen is as gas prices rise, as industry will start to invest. And then as we're successful, as we unlock the continent, then the gas prices will start to come down. Now, the timescales you can argue and debate about, but that is absolutely the clear model. So I think America has absolutely shown us the way that we should do it. And then, of course, once you do have the gas at a reasonably low price, yes, you can consider things like using it far more for transport, et cetera, and really lowering the carbon footprint.
But what the Americans did was to stop LNG, not stop completely, but curb LNG exports. If we're going to use that gas domestically, we're going to have to do the same thing, surely, and follow the American model.
Quite the reverse. What the American model did is they didn't interfere. They allowed the market to work. They allowed the prices to rise. At one stage, they went all the way up to $12. At $12, everyone was drilling like crazy, and then the prices came down. We need to do exactly the same thing, rely on the free market, rely on industry to get on with it, encourage them to allow them access to the land. Now, obviously, as I've said, the industry has to perform very well there. We have to demonstrate that we earn the trust and respect of the landowners. We're seeking to do that. We'll continue to work on it. We need access to the land, and then we need to be allowed to move forward. So I think the American model is a perfect one. And what that's going to do, of course, is absolutely unlock our resources.
David, you'd be very aware, though, wouldn't you, that in Western Australia in particular, but elsewhere, the states are looking at whether they can reserve some of that gas for domestic uses. And presumably at prices that reflect today's domestic gas prices, not market-related, export-related prices.
In Western Australia, yes, there is a 15% reservation policy. That policy comes into effect that when you come up for a development, you have to answer the question of demonstrating commercially that you can both export and also supply to the domestic market. But it's not a price mechanism. As soon as you restrict prices, in effect, we won't get the drill bit out because we won't be able to afford to do it. Gas is not cheap in Australia right now. What we need to do is be allowed to move forward, get the drill bit out, unlock the technology. It's that's going to drive down the prices. And I think I'll go back to the American model. It's a superb example, one that the industry never anticipated, of how when you use technology, when you do it at scale, the results are quite extraordinary. That's what we need to do, and we need to get on with it. If someone says to me, David, you've got to restrict gas and you've got to sell it for $4.50, I can tell you it's going to stay in the ground. It is not going to be delivered to the Australian consumer. But if someone says to me, David, I allow you to move forward, I want you to drill, I want you to unlock the resources. Of course, I want you to do it responsibly, I want you to do it safely. Absolutely, we're up for the challenge, and I think we can meet it with the extraordinary resources we have in this country.
Where is this gas?
Well,
geographically.
Yes, so the gas is geographic. Principally, obviously, the coal seam gas fields have proved to be probably far larger than we anticipated. They're largely in Eastern Australia. In Central Australia, in the Cooper Basin, then there is an awful lot of shale, potentially, and there's an awful lot of what we call conventional gas, but it's basically gas in normal sandstones. And if we move in the Cooper Basin, there's also a large amount of shale. As we move up into the Northern Territory, there's also lots of shale. Of course, in Western Australia, there's huge offshore gas resources, but there's also onshore gas resources. Some of that in tight rock, some of it in shale. Australia is very fortunate that it's blessed with really good gas resources. But as I say, it's a very large country, and as a result, it isn't cheap to develop these resources, and our industry is not that large. We don't have 1,600 rigs. We have more like 30 rigs, onshore rigs in this country, or actually probably even less, but about 30 a day. So what we need to do is build scale, and by building scale, we will start to drive down the costs. And not only then can we continue to compete in the Asian market, but it'll become prices in Australia in the long term will also be able to drop. And that'll obviously spur the manufacturing sector.
Mike Yeager, BHP Bilton Petroleum Division, said earlier this week that he was bringing some of his experts in shale gas from the States to Australia as part of a kind of quite an urgent quest for resources. You referred to the Cooper Basin before. You've got something like 85 trillion cubic feet of gas in the Cooper Basin, shale gas. Is there a Santos shale gas strategy?
Absolutely, there is. And as we've been saying, we've drilled our first shale gas well. It's a dedicated shale gas well. We've announced that we've successfully fracked that well in 3 zones. That's gone well. What we're doing right now is preparing the well to basically see if we can get any gas out of it. If we do, then that would be a fantastic result because this is a vertical well. What we'll then do is we'll then go on to drill more North American style horizontal wells. Typically, and the best that's been done in the States was in the Eagle Ford, where it took them about 10 to 20 wells to unlock that basin. We're on our first right now, so we've got a little bit more of a journey to do, but absolutely we're committed to doing it over the next 2 to 3 years. That will establish as to whether we potentially have a commercial resource here in Australia. But it isn't going to be cheap gas at first. What we've then got to do is really unlock the technology and start to do it at scale.
David, do you envisage a network of pipes up and down the east coast of Australia providing gas to the capital cities?
Well, we already have all the capital cities connected. We don't have a connection, obviously, between Western Australia and Eastern Australia, but all the capital cities are already connected with gas. There's good gas penetration. I would envisage over time that pipeline network will be strengthened. I would also envisage there may be a few additional pipes run, particularly one that might be run north from the Moomba to Sydney pipeline up to the Queensland pipelines. But I think we already have a good network. It probably just needs to be bottlenecking in certain areas. And that will allow us to bring the gas into that network and certainly distribute it to all the capital cities. But what we'd also like to do as part of this, we'd also like to start to distribute more of it to local landowners, local towns, so that they really see some real benefits from the gas game.
David, could you just briefly run us through the economics of
shale gas versus coal seam gas versus offshore gas?
Yeah, one of the key things with gas, not all gas is the same. The key issue with gas is, does it contain any liquids? In other words, any hydrocarbon, as in they're really like condensates. They're very, very similar to petrol almost if you actually get it out of the ground. Some gases contain quite a good level of condensate. For example, the Northwest Shelf has good condensates. Ichthyosis fields has good condensates. In the Cooper Basin, where we produce gas, we also have good condensate. And that actually is what's allowed us to produce the Cooper Basin and sell into a $3 to $4 market. It's not the value so much of the gas, but the fact that we get condensate with the gas, which in our case is exported through the Port Bonython plant here in South Australia. But in the coal seam gas area, there is no liquids associated with that. It's just pure methane that comes out of the ground. So not all gas is the same. And you have to be aware of where you get condensate and where you get just clean methane. The other issue with gas is not all gas is just pure methane. Some gas comes with a higher content of CO2 in it. So that's another factor that you have to handle, and that's another variable. So you can't just talk about gas as a homogeneous thing. It does depend upon its quality in the ground.
How far would you need to increase Cooper Basin prices before it became a global parity price?
So we've said that we'll be able to unlock the shale gas in the Cooper Basin at somewhere above $6, and that's what I believe we'll be able to do. Currently, we sell Cooper Basin gas for somewhere between $3 and $4. So basically, a 50% increase allows us to start to get onto the bottom rung, and then obviously, as we go forward, hopefully, we'll be able to sort of start doing that at scale. But that, I say, is some way off.
But very much appreciate your time and your cooperation.
Thank you very much.
Thank you very much.
It's a pleasure. It's been a great conference. It's been a pleasure to be here. It's probably been one of the largest conferences ever in Australia. So it's all about just developing the future and delivering our projects right now. And I thank you both very much for your time.